If you hold dollars, or really any dollar-denominated assets, I need you to understand something. Your portfolio is exposed to a structural risk that is simply not being priced in by the broader market. This isn't a forecast. It's an analysis of a signal that's already here if you just know where to look. So, what's the number? It's $94.30. And look, this isn't an opinion. It's a data point. The mistake most investors are making right now is looking at this and thinking it's just a new price for silver. It's not. It should be treated as a forensic signal, hard evidence of a deep dislocation between our paper financial system and the physical world. So when most people see this, they think, oh, silver is rallying. And that right there is the critical error in judgment. It's a sign that the underlying currency, the dollar itself, is starting to fail in its most basic job, to act as a reliable claim on real things. Understanding why that's happening is now fundamental to capital preservation. Let's put this in context. Think back to January 14th. The U.S. Mint, the very entity that makes the world's reserve currency, officially stopped all sales of its silver coins. Now, the official line might be supply chain issues, but from a strategic point of view, that's a technical sovereign default. It's a quiet admission that they couldn't get the physical metal needed to mint their own legal tender at the price set by the paper markets. That is a textbook signal of an early stage currency event. Okay, so let's get into our first pillar here. The force pushing this isn't what most people think. It's not monetary speculation. It's a structural, absolutely non-negotiable demand shock coming from the very core of the new economy. And that changes everything about this asset. You see, the biggest mistake people make is they're still looking at silver through this old monetary lens. But its role has been completely redefined by technology. For the world's biggest companies, it's not a precious metal anymore. It's essential infrastructure for the entire AI revolution, and it's just as critical to their operations as energy. Let's get really specific about why this is happening. The demand from AI isn't optional, you see. When you have something like NVIDIA's new Blackwell superchips, they generate an incredible amount of heat and data speeds that make traditional copper wiring basically useless. To maintain signal integrity, you have to use silver. Its conductivity is just a law of physics, not some economic choice. And that makes the demand from giants like Microsoft, Google, and Amazon completely inelastic. So here's what this means if you're managing real capital. The signal to watch isn't the daily flicker of the COMEX futures price. No. The real signal is what companies like Samsung are doing. They just made a $7 million prepayment to a mining company for silver that hasn't even been dug out of the ground yet. That's not speculation. That is an act of supply chain terror. It's a desperate move to lock down physical metal outside of the fragile paper system. And that corporate behavior, that panic, really, it leads us directly to our second pillar, the dangerous and, frankly, widening gap between paper claims on silver and the actual physical supply you can get your hands on. This gap is introducing a huge counterparty risk into portfolios that most people don't even know is there. You know, a lot of investors tell me they own silver because they have an ETF. In reality, you own a derivative, a piece of paper with a critical failure point. If you read the fine print, and almost nobody does, you'll find a cash settlement clause. That clause is an escape hatch for the bank that issued it, not for you. It legally allows them to just give you devalued cash if they can't source the physical metal. So you get left holding the currency, right at the moment you need the real asset the most. So again, here's what this means if you're managing real capital. The whole game has changed. The question isn't, what's the price anymore? The real question is becoming, can I even get the asset at any price? The risk has shifted from price volatility to simple availability. Now, I know what you're probably thinking. The first thing that comes to mind for a lot of people is the Hunt brothers and the market corner back in 1980. But let me be clear. That comparison is a dangerously flawed way to look at what's happening today. We have to analyze the structure of the demand, not just the shape of a price chart. Let's just break it down. Back in 1980, who was buying? Financial speculators. The demand was elastic. When the price went up, people stopped buying jewelry. Today, the buyers are strategic industrial giants. Microsoft isn't going to halt a data center build because of the price of silver. The 1980 bubble was popped by a rule change on an exchange, a margin call. Well, you can't margin call the laws of physics. This creates a hard structural floor under this market that has never existed before. Okay, so all of this physical market stress, it's happening at the exact same time central banks are facing their own endgame. And this is the ultimate accelerant. It's backing them into a corner where there are only two ways out. You have to understand, they're basically staring at a control panel with just two buttons. Button number one is the Volcker option. Jack up interest rates above real inflation to save the currency. But with today's debt levels, that would trigger immediate government defaults and a banking collapse. So that's out. Button two is to save the system. Suppress rates, print whatever currency is needed to paper over the debt. The result? You destroy the currency through structural inflation. And when you're faced with that choice, political reality, history, everything tells us they are always going to hit button number two. They will sacrifice the currency to save the system. And that $94 signal we started with, that's the market figuring this out. It's pricing in the consequence of a decision that, for all intents and purposes, has already been made. So let's bring all of this together. I want to leave you with one core strategic takeaway and a simple, clear mental model you can use to think about your own positioning in this environment. And here it is. It's simple, but it's absolutely crucial. Your wealth must be measured in assets that cannot be printed, not in a currency that must be. The unit of account itself is becoming the source of risk. So how do you do that? A practical way to think about it is what I call the ARC protocol. Think of physical silver as your offensive asset. It's positioned to capture this repricing from both industry and the monetary crisis. Gold is your core defensive asset. It's there to preserve wealth against the slow, certain debasement of currency. And the final piece is the transition, the plan to eventually convert that stored value from metal back into productive assets. Think farmland, real estate, infrastructure, but only when the value ratio between ounces and acres becomes rational again. This isn't speculation. It's an insurance strategy. I want to be absolutely clear. What I've laid out here isn't a prediction of some price on some date. It is a positioning framework based on an analysis of deep structural forces that are already in motion. Before we depart, please remember, the financial landscape is constantly shifting. The insights shared here are for educational purposes only. They do not constitute financial, investment, or legal advice. Every investor's situation is unique, and you should always consult a certified professional before making major decisions. Our goal is to help you identify the signal, but the final move is always yours. Stay sovereign, stay informed.